Have you ever pondered over the workings of options trading? Well, today we enter the intriguing world of finance to unravel the mystery of options trading. Options trading at its core is a strategic method used by investors to bet on the future price movements of a security. It's a contract that grants the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. Let's break it down further. An option is essentially a contract. This contract involves two parties, a buyer and a seller. The buyer purchases the right to buy or sell a security, such as a stock, at a predetermined price known as the strike price within a fixed period. The seller, on the other hand, has the obligation to fulfill the contract if the buyer decides to execute it. Now, you must know that there are two types of options: call options and put options. A call option gives the buyer the right to buy the underlying asset, while a put option gives the buyer the right to sell the underlying asset. Imagine this scenario. You buy a call option because you believe the price of the underlying stock will rise. If the stock price does increase above the strike price within the contract period, you can buy the stock at the lower strike price and then sell it at the current higher market price, making a profit. If the stock price doesn't rise as anticipated, the most you can lose is the premium you paid for the option. On the flip side, if you buy a put option, you're betting that the stock price will fall. If it does drop lower than the strike price, you can buy the stock at the current lower market price and sell it at the higher strike price specified in the option, again making a profit. If the stock price doesn't fall as anticipated, your loss is again limited to the premium paid for the option. But remember, options trading is not for everyone. It involves significant risk and requires a deep understanding of the market. Options can be an effective way to hedge against potential losses in other investments, or they can be used to speculate on the direction of a market or individual security. To sum it up, options trading is a financial tool that offers investors the right, but not the obligation, to buy or sell an asset at a specific price within a certain period. There are two types of options: call options for buying and put options for selling. The potential for profit in options trading lies in correctly predicting future price movements of the underlying asset. However, it's crucial to remember that this form of trading carries considerable risk and requires a thorough understanding of the market. So before venturing into the world of options trading, ensure you have a solid grasp of the fundamentals, a well-thought-out strategy, and most importantly, an understanding of the risks involved. Remember, in the world of investing, knowledge is your most valuable asset.